Wall Street just got punched in the mouth for the third day in a row, and the culprit isn't who you think. The real threat today didn't come from earnings or AI hype. It came from geopolitics and a bond market that's flashing warning signs. Let's break it down. The S&P 500 dropped 0.2%, closing at 7,353. The Nasdaq got hit even harder, falling nearly a full percent to 25,870. The Dow slid 0.65%, landing just below 49,364. But here's where it gets spicy. The 10-year Treasury Yield spiked almost a full percent in a single day, jumping to 4.67%. That is a massive move for bonds. And the 30-year yield, it reportedly touched levels we haven't seen in 2 decades. So why is this happening? 2 words: Iran tensions. President Trump issued warnings about resolving the Iran standoff, and the bond market reacted violently. When geopolitical risk spikes, investors start repricing everything. Higher yields mean borrowing costs go up, mortgages get more expensive, corporate debt gets pricier, and stock valuations, they get crushed under the weight of a rising discount rate. But here's the kicker. Vice President Vance came out saying there's been a lot of progress in Iran talks. Meanwhile, NATO's top commander said they are not drawing up plans for a mission in the Strait of Hormuz. So the diplomats are saying one thing. The bond market is saying something completely different. Somebody's wrong. Now layer this on top. The so-called Magnificent Seven: Alphabet, Apple, Amazon, Meta, Microsoft, Nvidia, Tesla, the stocks that carried this entire market for years. Analysts are openly questioning whether they're losing their luster. When people start asking, why would you even buy a broad market fund instead of just owning these 7 stocks? And then the answer starts to shift. That's a sentiment change you need to pay attention to. Think about it. If the mega-cap tech trade unwinds even slightly while yields are surging, you get exactly what we saw today. A broad, painful sell-off with nowhere to hide. And the backdrop isn't exactly comforting either. Unemployment sits at 4.3%. The yield curve spread is positive at 0.54%. So we're not inverted, but we're not exactly in boom territory. Market sentiment reads 60 out of 100 still in greed territory, which means investors haven't fully priced in the risks yet. Now here's what's coming in the next 48 hours that could change everything. Today, the FOMC minutes drop. That means we get to see what the Federal Reserve was really thinking behind closed doors. Tomorrow, we get building permits and housing starts data. With yields surging like this, any weakness in housing could accelerate the sell-off. Oh, and one more thing. Trump's approval rating just dropped to 35%, with even Republican support softening. Political instability plus geopolitical tension plus rising yields. That is a cocktail that makes Wall Street very, very nervous. So what's the bottom line? This is not a one-day story. 3 consecutive down sessions, exploding yields, fading tech leadership, and a geopolitical wildcard that could escalate at any moment. You don't need to panic, but you absolutely need to pay attention. If this kind of breakdown helps you stay ahead of the market, smash that subscribe button so you never miss a beat.